Hi, Joe Kehrig with the Kehrig Real Estate Team, and this is your San Ramon Valley update. And today we're going to talk about mortgage rates and how the economy affects the mortgage rates and what it's doing to the inventory right now. So when you look at this first slide, here's the bottom line. The worse the economy is doing, the better the interest rates are. And so we've seen 4 straight months, as you can look at this chart, of the unemployment rate rising. So again, and the inflation situation has gone down, but unemployment's going up. So it's a perfect storm for interest rates to go down. And we've literally seen the interest rates dip, as you can see in this chart, down to the lowest level since February. Actually, they dipped to the lowest point they've been for a year. So they've already gone up to from like 7.5 to 6.5. And look at this with the mortgage rate drop. On a $500,000 loan, so if you're looking at a $500,000 loan, you can just double these numbers. But there's basically $400 a month difference, or $135,000 over the life of the loan. So if you're talking about $1 million loan, which is, you see more of those in our area than a $500,000 loan, the payment's going to be $800 difference. And if you paid them off for 3 years, it's going to be $270,000 difference. So even that percent makes a big difference. And so what has happened over, so you would think, okay, inventory will go down as more buyers come out. And that's what we're starting to see. And when you see the updates, you'll see that happening. But up to this point, up through June, you can see the inventory was increasing because the rates were higher. And actually they increased, if you remember from our updates, they peaked in July. And July is normally when they peak, because after July you get to August, school starts, people are taking their last minute vacations. You'll always see that inventory will normally dip and then dip for the rest of the year. And now that you have lower interest rates, people are going, geez, the economy's not doing good, or price is going to go down. No, you're really not going to see prices go down, because normally you're going to see less homes coming on the market. And with interest rates down, you're going to see more buyers out there, which is going to keep it in a seller's market and keep the prices up. And you'll see that in a minute. Look at this first graph. Here's the number of homes for sale, 2017, 18, and 19. And I split these graphs up so you could really see it, so it made a lot of sense. So here's 17, 18, 19. You can see, for the most part, the number of homes, the active monthly count, where it peaks in July and then starts going up, down October, November, and December. Well, look I'm going to add 2020, where you can see what happened. COVID hit, and after COVID, when the market was on fire, the inventory just skyrocketed down. And then you look at 2021, 22, and 23. Well, 2021, it was kind of the same type of thing. And then in 2022 and 23, so you see from 2020 up to 2023, the inventory rose a lot, but look it's still way below what we would call the normal years, 2017, 18, and 19. So these graphs are great to show you where the inventory is, how it's grown, but also how it's lower than it was. And look at so far in 2024. You see the inventory is continuing to go up. Matter of fact, year over year, there's 36% more homes on the market than there is now. But remember we talked about it? It's actually 36% less than what it would be during a normal market. So yeah, we say there's a lot more inventory on the market because of the higher rates, but and the buyers standing back, and also sellers being locked into a 3% interest rate. They don't want to sell and buy something else. So we've been seeing inventory come up, but now that interest rates have dropped a little bit, and now that we're beyond our peak of where the most listings are on the market, I think you're going to see prices stay pretty steady. It's funny when they look at this 5-year active inventory comparison, and the reason I put that up there, because it shows nationwide, and it shows over 5 years. In California, inventory is down 31% over the last 5 years. And that's the only one that we want to really be concerned about. But here's the funny thing about it. The inventory is, when you look at where the shift in inventory is where it's up. Well, look at what 4 states in the whole United States it's up with. Where are Californians going to, and where did they stop going to as they quit selling in California? Idaho, Texas, Tennessee, and Florida. Those are the only 4 states where inventory has actually been increasing over the last 5 years, because obviously, a lot came on the market, and now their market, because they don't have the transition of California buyers, has basically, their inventory continues to go up over 5 years. But look at this one, months inventory of homes for sale. This kind of says what a normal market is, 6 to 7 months, what a buyer's market, seller's market. You can see from 2020 it's gone up, but we are still in a seller's market, and anticipate that we will stay in the seller's market, because even though inventory is up, remember it's up 36% over last year, but lower, 36% lower than it was during the last normal years, 2017, 18, and 19. And now that we're not getting as many homes on the market because of the time of year, and now that there's more buyers because of lower interest rates, and the Fed's talking about 2 more cuts maybe this year, at least in the discount rate. Doesn't completely affect the mortgage rate, directly affects it, but it does affect it through a ripple effect. So expect maybe interest rates to go down, maybe even closer to 6, and then sometime in 2025, we might even see 5.5 to 6, where most people feel once it hits 6, the floodgates are going to open up with the buyers going out there. And they're talking about builders are overbuilding. Well, builders were overbuilding. Look at, in the 2003, 4, 5, 6. Remember what happened? We were sitting there with 2 million new homes on the market when the market tanked, the financial crisis of 2007 and 8. And so what we've literally had over 14 years, we've had an underbuilding. And you can see that it's going up and up and up, but it still is way below, going all the way back to 1970. So the builders are catching up, but we didn't build for 14 years, almost 6 million homes less than we would have, built in any other, 14 years, like say from 1970 to 1984. So again, the inventory is still low. We're going to see the inventory drop more this year, and as more interest rates go down, expect more buyers to be out there, and that's why we're always going to have a seller's market. Again, the homes, there's enough inventory now with that 36% increase where they're not just buying anything on the market. It still has to be of good value and obviously, show nicely. But you can also see it in our market. Look at the San Ramon market. You can see the last 3 weeks, remember inventory was growing to, 2 weeks ago, we had 115 actives and 66 pendings. And now you've seen the inventory, the pendings are staying about the same, but the inventory has been going down the last 3 weeks. That's what we're seeing all the way across the board. You see it in the Danville market, inventory down, the Alamo market, inventory has gone down, pendings have stayed about the same. And we see it in the Dublin market where pendings are down a little bit, but inventory is down a ton. So that's kind of what we're seeing. But because of the lack of inventory still, and more buyers out there, expect the prices to stay where they are now. You can see San Ramon, Alamo, Danville, Dublin, we're all been averaging about 100%, right around 100% of asking. Now, as we always talk about, realistically, it's probably 95% because we're still seeing a lot of price reductions where people think their home is worth what it was at the peak. Even though it's gone back up, it went up like, 40%, and then it dropped 20%, and now in some areas it's up that 20%, but for the most part it's up 10 or 15%. But if the sellers still want that 20% gain, they're just not seeing it and they have to drop their price down. Every neighborhood though is a little bit different. So don't hesitate to reach out, and we can kind of guide you through the process to see if it even makes sense for you to sell, because we'll talk about what is your plan. Is your plan to stay in the area, move outside of the area? So putting your home on the market is a 4-step process that you have to go through. You just don't decide to put your home on the market unless you get transferred and you have to sell, then that's one thing. But it's usually to evaluate your home, to see what the value is, and then check with the lender saying, okay, if we sold it for this much, this is what we would want to purchase. And then the third step is actually to go out there and look at homes, either where you're going or in the area, to decide, okay, does this even make sense? So sometimes we get to step 3, and yeah, you can say, hey, it's a nicer home for $500,000, but it's not enough of a delta to make sense with the cost of selling and the cost of purchasing. So that's where we come in, to basically work the whole plan out for you. So if you have any questions at all, give me a call, Joe Kehrig, 925-487-6838, or joe@kehrigteam.com, or visit our website to hear more about the Kehrig team, www.kehrigteam.com. Have a great week, and this is a very fluid market, especially with the election coming up, and the Fed next month going to be probably lowering the discount rate a little bit. So again, stay tuned.